Okay. So you finished paper one. I'm doing my best to grade it. Sorry, I'm a little slow this semester. Part of it's just fatigue. This class is 50 and it's supposed to be 40, so it's 25% more. Plus, we started the investment society this week, so I got all kinds of excuses. But I'm hoping, I hope I have them graded by Thursday, but I won't have them entered by Thursday. So you have to wait till this weekend. This, you can redo papers, and some of y'all have like one thing that's really killing your paper that you can go back and fix. So if you don't like the grade, don't panic too much because you have to see, and I'll give you a detailed score. You don't really want to fix paper one until later anyway. You need to get paper two done, so it's kind of leave it to the end. But hopefully I'll get them all done. I was gonna get a bunch done today, and then I realized my 2:30 class, I had extended it from 1 until 5. So it's like every time I turn around, I was like, okay, there's 4 papers I could have gotten graded. So I'll do my best. So you got your paper two going. I did bring in what Bloomberg had for ESG. So if you just wanted to see it, they have what's called an ESG score. I have no idea what that means. So you might do a little research. You probably Google Bloomberg ESG score, disclosure score. Not even Bloomberg, it might just be something that they disclose. This is Exxon. Oh, sorry. So, it's so slow. Now, I've noticed a few of your stocks have had some huge stock market moves in the last few weeks, days. So I remember when NVIDIA dropped like 30% during this semester. That's kind of tough. Fortunately, you haven't done valuation yet, so you have to figure out what do you do if valuation happens and then your stock drops 30%. That can be. All right, so Exxon has this disclosure score. Microsoft score is 43. Best Buy is 33. So I have no idea what these means. I've never looked them up. I don't even know if higher is better or lower is better. Anybody know if y'all use this number? Higher is better. So Exxon's better than Best Buy. So yeah, I don't. You would think Exxon would be like 90. I mean, like 20. And Microsoft, since they're actually buying these anti-carbon, machines that take carbon out of the air when they're not even a major producer, you think they'd have a high score. So I don't know what that means. It does show the pieces, energy consumption. So there is other stuff. They have some social scores. They have a social disclosure score, whatever that means. I'm sure it's, it's the workforce and how that's broken down, how many employees they kill. In governance, they have some things. So there is some stuff there. You may want to look at it and see. I'm not a big ESG person because that didn't exist. When I was in finance, we didn't care about all that stuff. It's like, kill people, kill the environment, who cares, just making money. So now we're much more conscious of these things. So it's hard for me to think about these, but this is a big deal that you probably want to get into your paper, just have a section on it, just so you can say you're with it. But I just don't know how reliable these measures are, what they mean. So anyway, but they all had similar kind of things. You can see some have holes and blocks in their numbers. And what I'm not even sure is if you can even compare one company to another, if it's really that sophisticated or not. So, but those are kind of things that they're measuring. Try to have something in your paper too on ESG. Do your best to try to find it. You might even, I don't know if any of y'all tried just typing ESG in your company's name or in your annual reports. My guess is your annual reports probably have an ESG section now, and you can read through that. You can't really trust that too much because it's the company's biases. But try to put something in there. It doesn't have to be pages and pages, but at least acknowledge it. So any questions on that? So a new thing. How does ESG investing go? So what if you pick stocks and base entirely on the ESG score? So if you have a stats class, so, you know, you have a entry-level job, go pull a bunch of ESG scores on companies and see what that means for them and their performance in the stock market. Do you think it would be a good deal? Only buy companies with high scores like Exxon that are really good for the ecology and all that, and avoid Best Buy and Microsoft. Would that give you a higher return? There's some debate on that. We had I ran a mutual fund that was, oh, what do we call it? It wasn't necessarily socially conscious, but it's for little kids. It was like a kid starter fund. It was a horrible mutual fund because it was so expensive, because the average balance was a few $100s. So the expense ratio was like 1.4%, which is a horrible fund. I hated that thing. But we could never figure out what that even meant. They say no alcohol. And so you're saying we can't buy Kroger's? Oh, you can buy Kroger's. You say, but Kroger sells alcohol. Yeah, but they don't produce alcohol. Okay, that's fine. Guns, we can't buy guns. Oh no, this is USA. Their kids all have guns. Guns is fine. It's like, what about Exxon? Oh, you can kill the environment. This is USA. That's fine. It's like, what can we buy? So to me, it was really confusing. And then they violated the rule once, and I forget what it was, and had to write up this big report. And then what do you do right now? What is Philip Morris is buying whom? Philip Morris is buying a firm that provides medical treatment for people with respiratory problems. That sounds pretty ironic, doesn't it? So what does that mean? We now we can buy Philip Morris now. At least they treat them on the other side. I don't know. It's really, really tough to do this type of ESG investing because it's just so ambiguous. I'm not saying it's not important. I think it's extremely important. I just don't know if you can actually define it well enough to be actionable. All right. So we're going to move on to paper 3. Paper 3 is the most straightforward one. It has a very, very precise rubric. We're going to spend a few days introductory to it and just getting into it. Some of y'all have seen this. Sophia already knows this. Who else was in my class? Harvey, Sergio. So a few of y'all have seen this before. So it's going to be real similar, but you can have a different company. So this is a good chance to review. Make sure you remember this. With a quick accounting review, make sure you're there. Before we do that, I forgot to tell you about the investment society. So we are starting our classes. Some of the people in this class are teaching some classes. So Sergio is doing the market concepts. Oh man, what happened over here? That's real strange. Okay, well, there's our Zoom. There it is. Wow, that was strange. All right. So if you haven't gotten Bloomberg Market Concepts on your resume, that's a good chance to try that. Jabari's doing a real estate sector. Dante's doing discretionary. Bond in our class is doing staples. Fernando's going to do information tech. We have a materials team. So you're welcome to attend those things. Tomorrow I'm doing a forecasting class. I'm going to try to forecast Costco using Capital IQ. So if you want to see how to do that, you can come learn that or watch the videos. The sector teams, if you join a sector team, one of our teams, Thursday at 4 and 4:45, they're essentially going to build your paper 7 for this class in that session. And you learn Bloomberg and Excel and other things. So it's not it's a good use of your time, good networking, but you also get one of your papers, essentially over half of your paper done. And that's so I emailed this out, so y'all have this, so you're certainly welcome to join those. All right. I don't know who's on the Zoom. Hopefully they can see Brandon and Chris can see my Word document. Y'all let me know. If not, make sure it's recording as well. My life insurance class last week, I got the email and it was a really small file, and that's like, yeah, something went wrong. It was 4 minutes of whatever. So y'all let me know if it's not recording. Oh, did I? Sorry. Right. You know, you take all the hours they gave professors training on Zoom, you would think I would know how to do this, but yeah, the 0 minutes of training they gave us. All right. All right, so you're not accounting majors. I know people who switched from accounting to finance because accounting was too hard. I have really bad news for those people, but yeah, there's people who do that. They started a new accounting class for finance majors, the watered down accounting. I hate that. So who should know accounting better, accounting majors or finance majors? Absolutely, finance majors should know accounting a whole lot better than accounting majors do. So if you don't like accounting, you're going to have to deal with it because finance does a lot with accounting. So some students ask me, well, should I get an accounting degree? I don't think getting an accounting degree is actually that useful for finance. And the reason for it is undergraduate accounting, even graduate accounting, is too generic. So when I started at USAA, we were doing life insurance accounting. That was my starting field, starting a life insurance company. Oh my word, nothing looked like what we did in college. We didn't have deferred revenues, and I didn't know what that was. We didn't have loading, and we didn't have negative loading. We didn't set up reserves for that. We didn't have DPAC or DPAC unlocking and all that kind of stuff. Reserves, insurance reserves is 80% of the liabilities. We didn't have reserves undergraduate. So the problem with loading yourself up on, what is it, 36 hours of accounting? It's 36 hours of very generic stuff. So the accounting you got to learn is an industry specific accounting. So when you find your industry, you need to beg them to let you go take an industry specific accounting class. So USA let me go take a life insurance accounting course. It was specific just to life insurance stuff. You learn all that stuff. And they had classes in Chicago and New York and Boston and Durham, North Carolina. And guess where they sent me? Durham, North Carolina. And it's like, thanks a lot. But they had these really good classes. So the other thing you do is when you get into the company, you've got to go find the accounting people and say, okay, what are the things about this industry that are really, really unique? If it's an HEB or a Walmart, it might be the inventory accounting that's really, really critical that you want to look at. If it's a bank, it might be the reserving for loan loss. You know, who knows what all. In insurance, it's the actuaries, it's the stuff that the actuaries do. So the most important accounting for insurance companies is done by the actuaries. It's not even done by accountants. So that's what you get into. So it probably doesn't help you to take 36 hours because you're going to have 30 hours of a bunch of stuff you don't need. I had my advanced accounting. We did all these mergers and acquisitions. I never needed that stuff. It was really interesting and fascinating, but I didn't need it. My 2 cost accounting classes were exactly the same. I had the same class twice. The second one was easier than the first one. It was an advanced cost accounting class, and it was easier. So I wasted a lot on the accounting classes.
Sure.
So,
36 hours of accounting.
I took 30, but I think today you have to do 36 hours. You can take the exam.
Oh, okay, but not.
I was an accounting major. I wasn't a finance major. So I got an accounting degree.
Or something is just like 3 classes.
Yeah, but 3 classes is probably enough for a finance major. So you need to know what a debit and credit is. You'll know that. You got to know what a balance sheet, income statement, cash flow statement are. The statement of owner's equity is not that critical. But we'll talk some. There's some FASBs you really, really need to know. If you're going to interview for the bank or insurance company, you better know the 3 levels of asset valuation. And hopefully you're having that in your accounting classes. But that's really, really critical. I think it's FAS 150 or whatever it is now. There are certain FASBs that you really should get to know that are just really, really critical for certain industries. But a lot of the accounting I took, you know, well, the auditing classes, those weren't all that valuable. So that didn't really happen much. So, you know, so I don't, you know, students say, well, should I be a combined accounting and finance major? I'm not sure those extra accounting hours are going to really help you all that much. It is nice to have a CPA because firms do hire finance majors with CPAs because they kind of figure you can handle the accounting, but I don't think it's that critical. I'll give you some ideas of some FASBs you really should make sure you know. The other issue we have is the international standards. And when are those going to finally hit? They're probably not even covering those yet, right? For y'all. But if the international standards ever hit, you're going to go back and relearn everything anyway. So it's probably not a good time to become an expert on US GAAP because eventually it's all going to change. But we'll talk, there are certain things you need to know. You need to know how to, you know, we're going to talk about this in my class. If you have a balance sheet, an income statement, and you produce cash flow statement. And we're going to talk about that. That's really, really critical. They test that on the CFA exam. So that's a pretty important skill to have, mainly because it shows that you understand how the statements are connected to each other. I was so hoping for that question on the CFA exam, and I did not get this question. The study class I took, they spent the entire day on this, and I was like, I already know how to do that. I'm like, I'm the CPA, I already know how to do that. So give me that question. I didn't ask that question. The question they asked me, they gave us all these financials, and they say, fix it, fix GAAP. GAAP is wrong, fix GAAP, and we're supposed to go in, and that was the worst thing for CPAs. I was like, GAP's not wrong, that's what I learned. So I got the worst questions. So we'll do that in my class. We won't do that in here, but there are certain things you should know as a finance major. So the financial statements, you have two jobs. You've got the financial position statements and you got the period of time statements. So the position statements, the balance sheet, is that 1 second in time shows you what this firm owns, what they own, and then who has claims on that, the liabilities and the owner's equity. But it's only right for 1 second. The next day, interest rates change, everything changes. And then the period statements tell you how you get from one balance sheet to the next balance sheet. And you have the income statement and the cash flow statement. Which one's better? Yes, they are. They both have their stuff that is important. The only statement we won't use is the owner's equity statement. Not because there's not important stuff in it. There's important stuff in it, but it exists in other places, so we can use it. Things like comprehensive income and a lot of the stuff they're doing with fair value accounting probably won't affect most of your firms. That's more for banks and insurance companies. FASB accounting, you should print this out and carry it in your wallet. Because who works for whom? Does accounting work for finance or does finance work for accounting? And you say, well, let's go to the accountants and ask what they think. What would they say? Well, here's what the accountants say. The accountants say accountants work for finance. And one of my students got carried away and he told an accounting major to go get him a cup of coffee. And he said, no, that's not how we're talking about it. But FASB itself, accountants say that accounting reports to finance because it says, what's the purpose, the objective of GAAP accounting? It's useful to whom? Do those sound like accountants? Investment and credit decisions, does that sound like an accountant? No, that sounds like a finance person. The second thing, and this is, boy, I had a heyday out of this. For assessing future cash flows, they finally told me I couldn't talk to auditors anymore because every auditor conversation, they tell me you got to do this. Like, how does that help me assess future cash flows? And the Pete Mara guys finally just said, we don't like you, we don't want to talk to you anymore. So it's pretty effective, you know. Being told by auditors they don't want to talk to you anymore, that's like a prize. That's kind of nice. But yeah, he was telling me to make these entries. Y'all should account for it like this. And it's like, you know, GAAP accounting is supposed to help you forecast cash flows. It's even listed as a separate item. So tell me how fair value accounting is going to help me project future cash flows. Just did not make sense to me. And then the last one is, yeah, we need to build balance sheets, income statements, and cash flow statements, but it's back to this point. So carry this around. It might get you out of conversations with auditors, but I wasn't being mean. I was saying, hey, your profession says this is what you're after. You tell me why you're telling me to do this related to this. And the Pete Mara guys are like, hey, we're just sick of being sued. Just please do this because it's conservative. They just didn't care anymore. And that happens a lot with accounting. You know, it's just like you just get into the weeds and you get the bigger picture. So this is what accounting is supposed to do for you. How good of a job does it do? You know, it kind of varies over time. I'm actually in the field, in the opinion that fair value accounting actually makes this worse. And those 3 levels of accounting, did y'all study that? I can't remember. I should find it. don't remember which FASB it is. So did y'all study this in your accounting class? This would be like a really critical thing to study. Level 1 assets, level 2 assets, level 3 assets. That sound familiar? Who's heard that before? Nobody. Wow. They should be teaching y'all this. There it is, FAS 157. So level 1 assets, those are assets that you have a obvious market value, like a stock or a bond. Level 2 assets are those that do not have a regular market value, but there's some model or some basis for valuing them. And then level 3 assets is just make up a number. So I don't know where real estate fits in there, but you know, probably a lot of real estate, you probably could set up a model. You could have a pretty good idea of what that's worth. But this is huge. If you're doing banks or insurance companies, they've got a lot of assets that fall in these categories. You know, think about Lehman Brothers going under in 2008. This was their issue. How do you value these assets? They had assets that did not have easy market values to them, very complex. How do you value them? We had this issue when I was doing mutual funds. The bond mutual funds had this rule that if a bond fell by a certain amount, a committee had to get together, and I was on that committee. My first 2 years, we never met. And in 2008 came along, our meeting every single day. And the reason was we had this bond that hadn't been traded forever. It was just sitting there. And then suddenly somebody in Minnesota traded a smidgen of this bond, a few shares, but the market price was like 30% below where we had it valued. This one person had a desperate fire sale, sold the bond. Does that mean we have to write in this bond? We're holding like $200 million in this bond. Do we have to write it down 30% now because one guy sold a couple of shares? That's that kind of thing going on. That's huge, right? You're a mutual fund holder. You want to know what your bond return is. And here's these people debating, no, that was just one little trade. We're not going to do, are we going to make that trade? You know, that's pretty material to your portfolio. So this is a big part of the accounting. So FAS 157, I don't know who teaches y'all's finance, your accounting classes. That would be a really good one for them to cover because that's a huge one. If you interview in finance, if you're interviewing for investment banker, this is the FASB they're all talking about because it's having a huge impact on their banks, on their valuations, on their portfolios, especially on the bond side. More, you know, most stocks are what? Most stocks are level 1. Pretty straightforward. There's not a lot of debate there. I had a debate on my options. I had options in mutual funds, and they were using closing price on the options. And I was getting some wild answers. And so I went to the accountants and said, I don't think you should be using closing price or last trade. They're using last trade. I think you should be using the midpoint of the bid ask. Because you have a call option that hasn't traded in like 3 hours, but they're using that last price. It could be off by 20, 30% easily. You know, options are pretty volatile. So, you know, you have these discussions. They're pretty material, especially in the investment banking side, the investment world. So there is some accounting you really need to know more in finance than you would other places. But most of your accounting, you're going to have to learn based on the industry that you're getting into. One thing I encourage you to do, if you're interviewing for a job, to go out and Google the key accounting issues for this industry so you can have some idea of what those are. So the accountants want the accounting to be useful for decisions. For it to be useful, they say it's got to be relevant, reliable, and comparable. Relevant means it's predictive. They just said that. So accounting is supposed to help you forecast, and it's supposed to give you feedback. So you've got this view of a firm that it's going to do this, and you get a quarterly financial statement. Does that confirm what you believe, or does it change your opinion? That's what accounting is supposed to help you do. You've got these hypotheses. You get a financial statement and say, oh, you know what? I'm wrong on that. I need to go this direction. They need to be timely. I think that's the one part of accounting we're really getting good at. Faster and faster and faster. I noticed that at USA as an accountant. It's just like the close the book date kept moving up. Reliability, you want it to be neutral and really represent what the firm is doing. You want it to be verifiable. That's why you have an audit. I doubt any of y'all are going to go out and look at your audit for your firm. My guess is all of your firms have gotten an unqualified opinion. But that's what the audit function is supposed to do, is to help, do some statistics to see if the data they're getting is reliable. Is it neutral? And this last one, I think, is the toughest one. Does it really represent the economics of this firm? So the CFA says there are certain things you should be adjusting GAAP for because it's non-economic. I've never understood that, because if accounting works for finance, why doesn't accounting just fix those things themselves? Why do we always do that? So what do you do with goodwill? Y'all know what goodwill is? Goodwill is you buy a firm for $1 billion, its GAAP net worth is $600 million. So what is your goodwill? $400 million. What do you do with goodwill? What does CFA say to do? Just write it off, get rid of it. I'm not going to ask you to do that. You can leave it on your balance sheet, but goodwill is there. Goodwill is interesting because if your firm's doing a lot of mergers and acquisitions, you're going to see a big piling up of goodwill. And there does come a time when the accounting rules say you have to write that off. If you obviously overpaid for a firm and you have $400 million in goodwill, you're going to have to write that down. Some people say goodwill is brand value. We talked about brand value a few weeks ago. You buy a firm, that goodwill, you're buying for that brand, maybe. So write off goodwill. What do you do with inventory accounting? So your firm is most likely doing what kind of inventory? What did your accounting class say? LIFO, FIFO, average cost? What do you think is the most likely? Is it still LIFO? Why do firms use LIFO? When did y'all have accounting? Was it like 2 years ago? But you remember it all, right? It's like really critical. So, well, at least when I was in college, firms use LIFO. Why? Because if you use LIFO for taxes, you have to use LIFO for GAAP. Why do you use LIFO for taxes? The cost of goods sold is going to be higher, right? Because last in should be the most expensive. You say it's the first out. That way you get higher expenses. You can end up with LIFO unlocking. Why is that? Because you have this inventory you haven't sold in 10 years. So the price is so old. So most firms use LIFO. Do any of your firms have a major LIFO unlocking issue that's going through, because it can really materially impact your cost of goods sold? It might be something worthwhile looking into. Probably not. LIFO unlocking is an issue when you have high inflation. We haven't had a lot of high inflation in the United States, so that's probably not an issue, but it could be. At USAA, we had DAC unlocking, but none of y'all have heard of DAC unlocking. Deferred policy acquisition costs of DPAC unlocking. I remember the actuaries came in and explained it to me, and I understood it. I really did understand it. But 15 minutes later, I completely could not explain it. It was so complicated. It's just ridiculous. So there's stuff like that going on. What do you do with deferred taxes? Such a bizarre accounting rule. Most of you just can ignore it. Assume whatever's there is good enough and just leave it there. But there's a lot of stuff there that has no economic basis whatsoever. And then the last one is what I think that you're going to really be frustrated on is comparability and consistency. Comparability is your ability to compare your firm to another firm in the same industry. If one's using LIFO, one's using FIFO, that's an issue. I think the capital lease issue is going away. I think the accountants, I don't know if y'all studied capital leases, but I think the accounting is going that everything's going to be a capital lease. There are no more operating leases, and make every firm look the same. I remember some students in my graduate classes, they were doing UPS versus FedEx. And they thought, well, UPS has got to be the better firm. It's more highly rated. And when they did the analysis, it looked like UPS was more levered up. But then they discovered FedEx did operating leases, UPS did capital leases. And what does capital leases do? It puts all this debt on your balance sheet where its operating leases don't. And it's just the difference, that one difference in accounting that made all the difference. So, and then consistency is, we've taken care of consistency because we're pulling our data from Bloomberg. So Bloomberg is just whatever is there, we're going to bring it in. But if they change how they do accounting on something, it's going to be hard to compare. It's unlikely your firm had a major accounting change. We used to pull our data from the annual reports, and it was really, really frustrating because you would pull 3 years of data like 2005, 2006, 2007. And then you get the 2009 books that get the 2008, 2009, but the 2007 was all different than the 2007 you got from the 765. Radically different. I mean, a good example, when I was at USA, when I first started, they accounted for annuities as revenue. So if you bought a $100,000 annuity, it was $100,000 of revenue. Well, my first year I was there, they changed the rules and they said annuities are not revenue. The life insurance company is not selling an annuity, they're borrowing money from their policyholder. So that $100,000 is no longer revenue, it's now debt. Does that have an impact? So revenues dropped like 60%. And everybody's like, wow, what happened to the company? Well, the expenses dropped 60% as well because you didn't have that, you didn't set up that liability. But they changed the accounting that this massive, massive business, they switched it from a revenue to a liability. It was major. And our CEO looked at revenue per employee. That was his #1 gauge. And guess what our revenue per employee did? It just nosedived. And we were explaining to him why that change was, and he never bought into it. He always thought, oh, you guys are just making excuses for me. No, we really did not get that bad in 1 year. So those are the issues you have. Usually with stuff like that, that's really major. A lot of times you'll see Bloomberg will adjust all those numbers back. What if you have a merger? And that some of you are going to have this issue in this paper. You have a merger, suddenly their revenues going from 40 billion to 70 billion. And you're talking about the revenue growth, say, wow, the revenue growth is really strong. Well, it's not really strong. It's just they bought another firm. And that's frustrating. So consistency can be a major issue. But that's why I recommended, be careful buying a firm that's going through a major merger or acquisition because it really can mess up the numbers.
What about for like management change for like for my company, they tell me the CEO step down and then somebody else.
Yeah, that shouldn't be an issue for accounting. It's definitely an issue for paper 2. You want to talk about it a lot in paper 2, but for accounting, you shouldn't notice that. Now, I know y'all have stock options, all that kind of stuff. Stock option accounting can be a mess for some firms, no question. Some of y'all, well, you're doing utilities. Who's doing Exxon? I think that's Harley or who's doing Exxon. A lot of energy companies have these master limited partnerships. They're a mess. So if your firm has any kind of minority interest, that kind of thing, that can be a messy thing to have to deal with. So there's some stuff the accountants do that are paying. Some of you are going to have debt on your balance sheet and no interest expense. How can a firm have $4 billion in debt and no interest expense? That's really frustrating. How do you handle that? Apple might be like that. Why might Apple have billions of dollars in debt and no interest expense? Any guesses on that? I think someone in here is doing Apple. How do accountants account for interest expense? It's a net number. What are they netted against? Interest earnings. So if you got $100 billion in debt, but $400 billion in cash and short-term bonds, you might have more interest income. You have interest expense. It's really frustrating. Your firm has debt to equity, but your times interest earned is infinity. It's like, wow, that doesn't make sense. So the accountants are doing their best to make life miserable for us. And it's not because they're incompetent or they're trying to be, it's because these companies are really complicated. And the accounting is trying their best to try to get their hands around this. There's also a political side to this, where there's certain accounting rules that are there because if they did what was right, GM would be insolvent, and they don't want to have GM go under. There's things where these political compromises on the accounting, and then you have the SEC up there trying to get changes. So you're stuck with what you have. Just realize on the CFA exam, that is one of the questions: is take GAAP accounting and fix it. We're essentially going to take most of the GAAP accounting as is, as it's given to us, but there are places, and we'll talk about some of the more obvious places that we change. All right, so we will be using the balance sheet. The balance sheet is going to be extremely important when we talk about net working capital requirement. So we're going to get into that. I want to ask Sophia and Sergio and Harvey, do y'all remember that?
So
All right.
Net working capital requirement. Source of cash.
Source of cash, yeah. All right, so you remember, good. All right. I just covered them on my graduate students, and boy, they were like, we don't buy it. All right. So you have assets. What kind of assets we're going to look at? Well, we're going to really focus really hard on accounts receivable, inventory, prepaids. That's going to be our focus, those working capital assets. Non-current assets, about the only thing we're going to do there is you want to look and see how big property, plant, and equipment is to your overall balance sheet. Is it 5% of your assets or is it 70% of your assets? So if you're doing an Intel, property, plant, and equipment is going to be massive. If you're doing NVIDIA, it's going to be pretty small, right? Because NVIDIA doesn't do fabrication, Intel does. So that's pretty important. And it can be interesting, hotel chains, whether you franchise or not. McDonald's is a franchisor, so you might expect McDonald's to have this massive property, plant, and equipment, but if they don't own all those stores, it's much smaller. That's kind of a big impact when we start talking about turnover numbers. Intangible assets, we're essentially just going to ignore them. We'll just leave them there. You will notice in Yahoo Finance, where this is. So let me do HPQ. I've always wondered what. Well, they had a big stake in Alibaba, didn't they? Wasn't that like their only really good asset? But I don't know what else they do. Ugh. Okay, one of these days we're going to actually have an internet at UTSA. So look at their financials and look at their balance sheet. So Yahoo Finance actually, if you look at the very, very bottom, not the very bottom, but look, they have something they call tangible book value. So what is tangible book value? So tangible book value is the net worth of the firm minus these intangible assets. What do you notice about Hewlett Packard? Their tangible book value is negative. Why is that? Because they have so much in goodwill. If you write off all of that goodwill, well, I have to admit their net worth itself is negative. But their total capitalization. So if you write off that goodwill, their net worth goes negative. Now, some of you are doing, if you do the sector teams, there are some sectors we're looking at not return on equity, but return on tangible book equity. Actually gives you a better R squared, a better correlation to the market. So there is some sense that there are investors that are looking at return on tangible net book. Okay. I don't quite understand that, because what's going to give you the higher return on equity? Return on equity or return on tangible equity? Return on tangible equity gives you the higher. So is that our goal in making this adjustment, that mushroom up the return on equities? So there is that discussion. What do you do with goodwill? For most firms, it's probably not an issue. Goodwill is, $6 billion out of, well, did I get Walmart? I always do that. I always get Waste Management instead of Walmart because our computers are so slow. So goodwill of 18 billion versus common equity of 77 billion, not that big of a deal. But if you take those intangible assets out and recalculate return on equity, it's going to go from like 12% to 15%. It's going to be material. So do you do that? We're not doing that in this class, but if you wanted to get into that, you certainly could. I'm going to show you a ratio that I do like a lot that I think you should use. So most of the intangible assets for most firms, it's going to be that goodwill. Trademarks, patents, those kind of things are usually pretty small. Maybe pharmaceuticals could have big patent numbers, but for the most part, it's going to be goodwill because your firms are buying other firms. Brand value, already talked about that. That's nowhere on the balance sheet, except for those that think goodwill is capturing brand value, maybe. Employee training, we just expense that. You might say we train our employees and that has a 5-year value, so maybe we should amortize it over 5 years. We just don't do that. Now, research and development. If you have heavy research and development, I'm going to talk about some key ratios you might want to calculate, but you also, need to look at the accounting. That's a pretty complex part of accounting that I don't know really well because it wasn't an issue where I work. My sense is accounting is moving faster and faster to expensing R&D, but there still are firms that can capitalize some of that. But R&D is an important number that you want. If your firm has a lot of, any of your firms have a heavy R&D that you know of, oh, NVIDIA or, yeah. Yeah, so there's going to be probably does as well. So you might want to look into the accounting for R&D and see if that's something that you need to make an adjustment for. There's some assets, questionable value, obviously goodwill. Property, plant, and equipment, you know, we're using amortized costs. We know that's a terrible number, but there's no other replacement. I'm not going to go to USA's balance sheet and figure out the market value of that huge building sitting over there. Who knows what that is? You know, you could look at comparable buildings. What's a comparable building of that building in Texas? There just isn't one. A Citibank used to come in and brag that their building was as tall as our building was long. So it had a little bit of a reputation, but you know, who's going to buy that building and what value is it even try to get a market value? And then you'd have to do it every year. And it would put so much subjectivity into the financials that you just would, as an investor, you would not want that. So, all right, then liabilities. Liabilities, our main focus there is going to be on accounts payable and accrued expense. And one I don't have here, it's really important. Get this in your notes because it's really important. Prepaid expenses. For some of your industries, this is huge. And it's a wonderful thing. I'm sorry, it's not prepaid expenses. It's unearned revenue. I'm on the other side of the balance sheet. Unearned revenue. So my prepaid expense is somebody else's unearned revenue. So what industry can you think of that this is a major liability for them?
Like gift cards?
Yeah, gift cards is an interesting one. I'm not sure the exact, but if you're doing retail, you might look into the gift card accounting. I know that's been a big issue in some years. I'm thinking airlines. You buy an airline ticket, they get your money, and you might not be. I usually buy my tickets, you know, 2-3 months out. That's wonderful. They got my cash. How much? What interest rate are they paying me on that? 0%. How much would you borrow at 0% if you could? If it's unlimited, how much would you borrow? I borrow like 18 trillion invested in German guilds or something, you know, or UK guilds. You know, yeah, it's free money. If you can borrow money for free with airlines, that's a huge advantage. Now they have a huge number of disadvantages, thin margins, heavy capital requirements, but unearned revenue is a major advantage to these entities. So yeah, so that's one that we need to bring in. Some of your companies, that's going to be a huge one. Non-current liabilities, obviously we're going to look at the debt. If you want to get into capital leases, you can. I think the accounting is complex enough that you can somewhat ignore this, but if you want to bring in capital leases and count it as debt, you're certainly welcome to do that. Benefit plans, for the most part, we ignore them for these classes, but there are some companies that the benefit plans are massive. Some people say GM is a retirement plan with a small subsidiary that makes cars because their employee benefits is massive compared to the size of the company. So, you know, that's an issue. I won't go into defined benefit accounting, but I had to do that when I ran USA's pension plan. It is ridiculously complicated and it's really bad. It's still really bad. There's a lot of subjectivity to it. There's a lot of lying going on in benefit plans. If your firm has a large pension plan, and there are some old economy companies like FedEx, Eduardo FedEx might have a massive pension plan. You might want to have to look into it. There's some assumptions they can make that can change those plans by tens of billions of dollars. I remember debating with the auditors. We were using a very conservative discount rate. And our auditor says, no, you got to use a higher discount rate. And his argument, he was looking back at what bond markets had done the last 20 years. And he was saying, well, bonds have made like 11, 12%. But I said, but interest rates are so low right now. And he was actually trying to get us to raise our numbers to reduce our liabilities. based just on history. And so there's a lot of lying going on. It's not quite as bad in publicly traded companies as it is in states and in cities pension plans where there's a lot of lying going on. Deferred taxes, I hate deferred taxes, and the rules have changed since I was in school. Did y'all cover deferred taxes at all in your accounting classes? Did they even come up? Was it pretty detailed, or was it like a 30-minute discussion?
It's another category.
It's another category. Pretty ridiculous, right? What they're trying to do there. You can see why they're trying to do that, but you have the permanent differences, you have the temporary differences, and it's just crazy. And this can have a big effect when the 2017 tax law changed. Banks were writing off a lot of deferred tax because they had these gains, these losses from the 2008 that they were passing through the future, but when your tax rate's lower, that benefit goes down, so the deferred tax. And so you're thinking, wow, their tax rate just went down. That's got to be a big benefit. Well, no, we're writing off $4 billion because of that. It's like, okay, you lost $4 billion because they reduced your tax rate. That doesn't make sense, but that's the way accounting works. Other firms have estimates, warranty costs. I don't know if that's going to be an issue for most of you. If you're not doing banks, but if you're doing banks, bad debt is a huge one. And banks have a lot of leeway there. It's really hard to trust one bank versus another bank. And then some obligations are not in GAAP at all. So what GAAP says is, and this is where you might get into the footnotes, GAAP says you have to have two things to put it on the balance sheet. Has to have more than a 50% chance of occurring and has to be difficult to quantify. If either one of those things is false, you cannot put it on the balance sheet. You have to put it in the footnotes. But the nice thing is, if one of those is true, they have to put it in the footnotes. So that's where the footnote can be pretty important. So who's doing Philip Morris? So yeah, those tobacco lawsuits. Can you imagine Philip Morris? They got these tobacco lawsuits. They've got to decide, do they have more than a 50% chance of losing? And if they lose, how much do they lose? Do you think Philip Morris wants to put that in their annual report for the plaintiff to read? So yeah, look, they think they have more than a 50% chance of losing. So yeah.
How do we measure that?
What?
How do we measure that?
Well, they have to measure it internally. You can't. That's all internal stuff. But they have a major lawsuit. They have to sit down and figure out what's our probability of losing, and if we lose, how much are we gonna have to pay out? And then they have to divulge that. So yeah, it's information they probably don't want to divulge. So if you have major litigation issues, then yeah, you might look in the footnotes and see what they have. Almost every firm has a lawsuit going on somewhere. You know, I was quoted in 2 articles this summer because USA's life insurance company was sued. And people were asking, well, you know, what did they do? How bad is it? You know, so it was interesting me being asked a question about USAA as a non-USAA person about a lawsuit. I was like, wow, this is really bizarre. So some obligations, operating leases, special purpose entities, there's things firms do. You might say, well, that's not that important. Well, go back to 2001 and 2002 with Enron and see if a special purpose entity is important or not. It can be really, really, really critical. Some of them are not a problem. USAA has special purpose entities because of their reinsurance agreements. It's perfectly fine that those are entities that are off their books, even though that entity only deals with USAA, and it makes perfect sense. A firm's 401k plan is a special purpose entity. It is not on their balance sheet anywhere, but that makes perfect sense because it's not their money, it's the employee's money. So I don't want, you know, if their employees have $10 billion in 401k plans, I don't want them to put $10 billion in assets and $10 billion of liabilities on their balance sheet. That money doesn't belong to them. If they go under, it belongs to the employees. The employees can't sue the company, you know, it's their money. The company can't get their hands on that money. So yeah, some of those are perfectly fine, but there's others that are, you may want to look into. And then owner's equity, you know, net worth, we'll talk about that. All right, then you have the flow financials. We'll definitely be using the income statement. You have revenues and expenses, and then you have gains and losses, but accounting does not like to put things below the line. Those extraordinary items, I mean, they've got to be really extraordinary to go below the line, but management does love to push stuff below the lines. They have what they call normalized earnings. Normalized earnings is what they say, hey, this is a one-time thing, take it out of your analysis, it's not going to happen again, we really made more money than we reflected. That they can tell you, and you can make those adjustments. So what I did on your Excel, and you may not like this, and if you don't, you can change it back if you want to, but on your Excel for paper 3, I actually brought in adjusted numbers. We've had this debate. There's a professor here, a really good accounting professor here. I really recommend you take from her, but I can never remember her last name, but Cheryl Lipcomb, y'all know her name? Her name, just excellent. She worked for the SEC on international standards, really great professor. She hates adjusted numbers. She thinks it's unreliable. Stick with GAAP, that's the numbers. I pulled adjusted numbers partly because it makes our life a little easier. It gets rid of some extreme numbers that we don't have to worry about these massive negative numbers. And it's more likely to be what investors are looking at anyway. So when we did our sector wars a couple years ago, one of the ladies on the panel, she asked the question, what do you think about adjusted GAAP? And the team had no idea what she was asking. So it was kind of embarrassing for them, but they did the right thing and they said, we don't know. I've had students who start talking and making stuff up on the fly, and that never goes well. But they said, yeah, we don't know what you mean. But her point was, why aren't you using adjusted numbers? That makes more sense. So what are adjusted numbers? It's someone out there that are taking a number and saying, you know, that's so unusual. Let's take that out and let's adjust for it. So maybe they sold a subsidiary and they had a $50 million loss. Let's take that $50 million loss out. That's not normal. Let's adjust some numbers. So how do you adjust for that? Do you adjust the tax number too? So their taxes were lower because they had this big loss. Well, if you can normalize, you're going to adjust for that as well. So that's the adjusted number. So you have the adjusted numbers. If you look at the Excel spreadsheet, see if I can find it. I can't remember where I put it. Yeah, I don't know where I put it. I thought I had it up here, but I guess not. But anyway, if you look at it, I really want to show it to you guys. I want you to know, understand how to use Bloomberg as well. So it's Walmart, so it's a W. So let me jump on to the end. All right, I'll show you next class, but I want you to see it. But you'll see the formulas in Bloomberg. So if you look at them, to get adjusted numbers, you got to put a lot of extra text into the formulas, but that will bring adjusted numbers in. I think it's just a matter of taking that text out and then you'll go back to actual reported GAAP, all right? If you want to try the two to see if it makes a difference in your company, you can. Oh, 0304, okay, thanks. That's true, I did put that in there. Yeah, it's 2018. Yeah, I'll do it next time. I'll find it. Yeah, sorry. So you might, you could easily switch, look at your print page 1, switch back to the other, look at your print page 1 and see if anything really jumps out from your company. And the reason you might do that is not so much that you want to switch to GAAP, but you just want to see what were the major adjustments my company made, because that might be eye-opening to you. It does mean when you're using adjusted numbers that if you're looking in the annual report, you may actually see different numbers in the annual report than what we have in our Excel file, all right? So that's going to be important. So I'm going to ask you on paper 3 to talk about quality of earnings. I'll show you how I do it. I do it in a really simple way, but there are better ways of doing it. But this whole concept of above the line and below the line. Most firms want to report very smooth earnings that don't jump around a lot. So if you can take an item that's really making your earnings lumpy and say, hey, that's below the line, that doesn't really count, then you got smoother. Big bath theory, that does happen in years like 2008 and 2020 when you have a really, really bad year and heavier. This is where the CEO can make an impact. You have a new CEO, The new CEO wants to load up all the bad stuff in that first year, so that their second year they look like a hero, right? So there is some of that. So a new CEO can cause that kind of accounting. But the real thing you're focusing on is accruals. Accounts receivable inventory in particular. That's where management can really lie quite a bit. So when I was at USAA, I remember talking to the loss reserve actuary. She intentionally overstated reserves by 3%. They put a cushion in there. She didn't have to do that. But what that meant with that 3% cushion, you could have gotten any net income you wanted. She could have taken that down to 2% or taken that to 4%. I mean, that's hundreds of millions of dollars, that one adjustment. So, all right. I think I'm boring y'all to tears or something, I guess. Sorry. I find this stuff really interesting, so sorry. All right. This is a book you should put on your holiday shopping list. I don't know if any of y'all tried reading this. This is not a book you can read on Audible. It just will not work. You've got to get the book itself. Any of y'all tried this book yet? This is not a book for accounting majors. This is a book for finance majors. So essentially what this guy, Howard, is talking about is how can you figure out if management is cooking the books? It's a pretty old book, and I wish he had a more recent, he might have a more recent edition, 4th edition. Anything more recent than that? So, and it's pretty inexpensive. This would make actually a pretty good textbook for an accounting class, a forensic accounting class that finance majors could take. But essentially what he's asking is, how can you tell when management is lying? I want to go to the index, but I can't do that. I don't know why I can't do that. Yeah, I'm not having much luck with anything tonight. No, so it used to be you could just click on it and you could get into the book, but they're not going to do that. But his chapters, he go through the different ways they lie. So how do they lie in revenues? How do you overstate revenues? How do you misstate expenses? How do you move revenue from one year to the other year? How do you move expenses from one year to the other year? But his whole basis, and why I think this book is so good, is when management lies in one balance sheet, it causes a hiccup on another balance, on one financial statement, it causes a hiccup on another financial statement. And what he's showing you is how you can find those distortions. So it's a really, really good book. I wish I could show you the inside of it. I tried that and it wouldn't let me. That's what I did before. Yeah, I'll show you. So recording revenue too soon, recording bogus revenue, boosting income using one-time unsustainable activities, shifting current expenses to a later period, shifting current income to a later period. Why would you do that? Because you have a really great year. You want to have smooth earnings. So you say, hey, I remember I was on the credit union board once, and they changed this accounting thing, and it was going to cause us this $500,000 loss. And so the CEO goes, do we do it this year or do it next year? And the whole committee goes, well, what kind of year are we having? It's like, no, that's not the question is, when should you record it? What's the right thing? It's like, oh, we're having a great year. Let's take it this year. So that's fine. Have that conversation, but don't have it by email. Have that conversation, out in the open without being recorded. But really, really good stuff he has on the cash flow statement. Key metrics, how do you distort metrics? Even talks about acquisition. So this guy, at the time I read his book, he had a web page, and you could pay him a few $100, give him a company, and he would give you a report. All the red flags you should have in your company. And then he got bought out by someone, I can't remember whom he got bought out by, by some firm, and they're using his technique. But it's a good book. I do recommend. It's well written, for an accounting book. And I think what makes it so interesting is he gives examples after examples. And there's a lot of really shocking stories about how firms did some stuff. There's one story I remember was a firm that was having a bad year, so they called their customers and said, can we deliver barbecue grills to you? If you don't want them, you can send them back in February. And they just mailed them out, put it as revenue, got them back. Yeah, you go to jail for that. That's fraud. You can't do that, but that's how they pushed up their revenue.
Is there a lot of financial statements and charts and graphs in the book?
There's a lot of financial statements, yeah, that you can actually see the distortion. Yeah, he does a good job of teaching it. I remember when I took the CFA exam, they had a book called Accounting. Man, really exciting textbook by some guy. His last name was White. They had a lot of great examples, but every example, they use actual financial statements, and there was so much complexity, you couldn't see the point. He does a good job of just showing you what you need to see. So this accounting book I had is like, it's in there, but you have to make this adjustment, this adjustment. It was just, you got so sick. So you really wanted to see it. Like they're trying to prove the impact of moving to LIFO and showing how the investment world got it, but it was so complicated. So he does a good job of not overcomplicating it, so you can really see it in the numbers. All right, so statement of owner's equity, we're going to completely ignore. I'm going to skip through that. Statement of cash flows, so you have CFO, financing, investing. We're going to use all three of those. Very, very important distinction. The cash from operations is essentially your income statement, but on a cash basis. Is what it's supposed to be. There's one error on the cash from operations, and it's interest expense. For some reason, GAAP accounting puts interest expense is subtracted out of CFO. So they leave interest expense in CFO, and it should be a financing activity. The CFA exam will tell you to make that adjustment. The problem is you can't make that adjustment because there's no place to get interest expense. For some firms, they actually capitalize interest expense, so you can't get it. In other firms, you net it against interest income. So CFA says make the adjustment, but you can't make the adjustment because you don't have the information to do it. So it's a little bit frustrating. So I don't make that adjustment, but that is one of those adjustments you should make. You should actually take interest expense and move it down to financing. Then the question is, well, what about the tax impact of interest expense? So it gets a little messy, no question. That may be why the accountants leave it in CFO, because it's really difficult. You can't really put tax impacts in investing activities. That doesn't really make sense. So it's just messy. Who knows? Interest expense may not be taxable for that much longer. They keep changing the rules, so who knows? We might get, so it's not even tax deductible, and maybe then they will move it down there. We'll definitely be using CFO. On the financing activity, we're definitely going to be looking at CapEx and asking, you want to ask a lot of questions about CapEx. What is the firm spending their CapEx on? You want to look at acquisitions. Is this firm doing a lot of acquisitions? So there's a lot of important stuff there. And then on investing, are they paying down debt? Are they buying back their stock? Are they paying dividends? That's going to be important. So we'll get some value out of those. There are two types of financial cash flow statements: of direct, indirect. Almost everybody does indirect now. I don't know anyone that does it direct. The direct would be pretty cool, where you just have an income statement, but on a cash flow basis. You have revenues and expenses. However, if you want to look at your firm's cash revenues, it's very easy to calculate. So remember from your accounting class, how do you get cash revenues? Any takers on that? This is something every finance major knows. So how do you do that? I know some of y'all know it and you're just scared to say it. So you take GAAP revenues and do what? So you're thinking CFO, depreciation add back. You're correct, you add depreciation back, but that's not related to revenues. What's the one balance sheet item related to revenues? Take GAAP revenues and subtract the change in accounts receivable, and what's that going to give you? That's going to give you cash revenues. So you can do that. What about cash cost of goods sold? This one's a little tougher. So you do cost GAAP, cost of goods sold, minus the change in what? Inventory, maybe the change in accounts payable. But the problem with that is firms' accounts payable may be for more than just cost of goods sold stuff. So that one's a little questionable. But So we haven't completely lost the direct method. You can somewhat get those numbers on your own by calculating themselves. But we have, for the most part, every firm does the indirect method where you start with net income and you add stuff back and subtract stuff. That's the biggest thing. Which is better, the income statement or cash flow statement? So yeah, they're both important. They both have information. Usually what you're going to find, if management's manipulating the books, the income statement is what they're manipulating. So that's what they're trying to prop up is net income. They're going to have to mess up some balance sheet account, and there's going to mess up CFO. And what you'll notice is net income and CFO diverge. They don't move together anymore. And that gives you a red flag that maybe management's doing something a little tricky. Maybe they have some accounts receivable that aren't really revenue. You know, if you're creating false revenues, it's hard to create fake revenues and get cash for it. That's kind of tough to do. Like the guys who send out the barbecue pits, they just sent them out and set up an accounts receivable and showed it as revenue. It'd be really tough and say, hey, we'll send you these barbecue pits, send us $10,000 and we'll give you your $10,000 back in 2 months. That would have been a lot harder. But hey, we'll send you a barbecue pit and you just mail it back to us later. That's a lot easier. You just show up in the accounts receivable. So I'm not going to ask you to read my blog, but you should read it at some point. Dr. Katapacum read it and he found an error I had to correct. So I'm kind of glad he read it. But let's get to the bottom line. Free cash flow. What in the world is free cash flow? It's the most important number in finance. If you took Dr. Katapacum's class, he talked a lot about it, right? He's kind of the king of free cash flow, which is why I was kind of nervous he was reading my free cash flow blog. But what is free cash flow? So there's another book I highly recommend. It's called Free Cash Flow Yield by a priest. Here it is. Free Cash Flow and Shareholder Yield. I wasn't even close, but William Priest. Really good book. Have any of y'all read this book? Because I recommend it a lot. So great book. Very short. It's kind of a nice thing about it. I forget how many pages it is, but it's readable pretty quickly. Not even 200 pages. Very readable, very understandable until you get to the appendix, and then it's impossible. And I think what they're trying to do is say, hey, our concept makes a lot of sense. This is what we do. Then you get the appendix and say, but you can't do this yourself. You need to hire us to do this. I actually went to William Priest. I think I'll tell you all some of this story. I went to his company right when I was retiring. Went up to New York and visited all kinds of people. So I visited their firm. They're thinking, oh, USA is going to hire us. I just wanted William Priest to sign my shareholder yield, and he wasn't in the office that day. So it's like, so I was like wasting my time listening to them. It's like, oh yeah, that's interesting. Yeah, I'll take this back to my peers. But anyway, cheap books. I still don't understand why textbooks are $300. This would make a great textbook for a class, and you'd get more out of this book than you would out of any textbook. But I just don't understand. $14. But what's his argument? It's a fairly simple argument. He says free cash flow is very hard to measure. I know Dr. Katapacum shows it to you, shows you a formula. You read my blog. I think it's more complicated than the formula we show, mainly because of capital expenditures. It's really hard to come up with a number. But what they argue is, while it's hard to calculate free cash flow, it is not difficult to tell if a firm has free cash flow because they'll do certain things. They'll pay dividends. Firms that produce free cash flows will pay dividends. Now, Bon, a couple of you are doing Costco. Costco is bizarre on the dividends. You're going to have to address that in your paper. Maybe you can give me an answer. I haven't gotten a good answer. Why is Costco all over the place on dividends? Some years it's a massive dividend. Some years it's almost nothing. It's like every 3 or 4 years, they just pay this massive dividend. Very strange. Most firms like to have a fairly constant dividend, increasing every year, like, Walmart. 79 cents, 81 cents, 83 cents just over time. So they pay dividends, they buy their stock back, which you're going to see a lot of that. Firms that buy their stock back, you're not going to buy your stock back if you don't have free cash flow. But then you got to watch out for the debt, because there are firms that are borrowing money to buy their stock back. So you're looking for firms that are paying their debt down. You don't pay your debt down if you're not producing free cash flows. And they're expanding the capacity of the firm. That's the hard one to measure, because that's part of CapEx, but there's other CapEx that's not expendatory. So, or whatever the word is, it's not expansive. So what you want to do is, what is the CapEx that's actually increasing the capacity of this firm? So for Costco, it's building new stores, which they actually are quite upfront about their books, what they build in stores. So you measure that fairly easily. For NVIDIA, what does that mean? What is NVIDIA's CapEx? What are they actually spending money on? And how do you measure that? Are they acquiring other firms? Firms that acquire other firms probably have free cash flow, although Dr. Demodarian says 90-something% of acquisitions are destroying value. So that's a little bit of concern. They could be holding in cash. If you have an Apple or a Google or a Microsoft, they're holding a lot of cash. You got to be real careful how you measure that, because it may not be sitting in the cash and cash equivalents. It might actually be in the investment line as a longer term asset, because if they're buying 2-year bonds, that's not going to be shown in cash. So you may have to do a little extra work there. So I'm going to give you some of this. We're actually going to measure this in paper 3. I'm going to show you how I do it, but you could actually go much deeper on your firm than this. All right. So yeah, there's shareholder yield. There's my blog. All right. So what we're going to do next time is we're going to do financial statement analysis. And we are going to do the first 3. The 4th part, relative value analysis, that's paper 7. So you're not going to do that. And we're going to follow it. The students had me before. They've seen this exactly, so they got an advantage. But you're doing a different company, right, than you did in that class, aren't you? No? Well, okay. Well, you can't use it anyway because it's a year old. So you have to, can't do that. You will use this template. All right? Repeat that. You will use this template. You can do more than the template, but you have to follow the template. All right? I still had that one student that didn't, but she hated my guts on her score. Now, why did she get a bad score? Did she get a bad score because she didn't follow the template? No, she got a bad score because I graded her paper without the template, and it was a terrible analysis. And that's the reason I went to the template. One thing that irritates the life out of me when I ask a finance major to do a financial analysis, the first thing they do is the current ratio. We don't use the current ratio in finance. It's a terrible ratio. It doesn't tell us anything. Why is it the one ratio we don't use in finance is the first ratio finance majors use? Because most finance majors learn their financial analysis in the accounting class. Accountants are not good financial analysts. All right, so we're going to use my template. I'm not going to tell you my template's great, but it's a very common template. All right, I'm not telling you something out in left field. I have a couple of things that I do that are left field, and I'll let you know, or you get the crazy sweet stuff, but most of it's pretty boilerplate kind of stuff. So you're going to follow my template, and it's going to follow this. So the rubric for this paper is very, very straightforward. Not only that, this is where you can copy and paste. I've already written this for Walmart. All you got to do is load Walmart and adjust it for your company. So how much easier can you get than that? And that's actually not that easy, right? It's a little more difficult than that because your company won't look like Walmart. But this is one where it's really straightforward. So you're going from paper 1, which is wide open, to paper 3, where I'm gonna put you very, very controlled here. But don't do the relative value. I always have students to do the relative value. It's like, I don't want that in this paper. Just like on paper 1, I didn't want macro analysis a separate section, and over half the students did that because that's where the student examples were. So, it's good that I know that y'all aren't listening to me. That's always encouraging for a professor. But yeah, on this one, make sure you follow this verbatim, except for don't do part 4. So we'll start here next time and we'll go through this. Probably what I'm going to do is I'll cover liquidity, and then we'll do the Walmart example for liquidity. So what you want to do in class is have your firm's Excel spreadsheet open while we're going through the class, all right? In this class, you're going to want to have your Excel open so you can start working on your company in class, okay? All right, so we'll start there next week.